Hey, good evening, everybody. Today I'm just trying to bring a trade out to you guys and mostly on earning that is going to happen in Lululemon. Um, the trade I'm expecting it to do is actually pin at 370 towards the end of the week. So ideally, I'd like to get in an iron condor. That is the perfect structure that I have drawn over here. um, what Iron Condor does is that it actually maximizes your profit. Two things that happens during earning. One is that the options implied volatility keeps climbing up and up and up and up and up, and due to the uncertainty with the earning, because there is an expected move of 0.87, but I mean other factors, it could go up or go down. We don't know, or it could be just going sideways without any impact. Um, Ideally, what I'd like to see is this or the other way around, whether it breaks out to the upside or break out to the downside with the iron condor, which I don't really mind. But ultimately, I would like to see this particular reversal. If it does happen on this direction, if it does happen on this direction, I wouldn't be worried as long as I see this reversal. So that's the whole construction of this trade. And uh, at this given point of time, and considering the market, let's just assume that the market is open and we will have to go this week, that is the 11th, December 20th. And the way you would construct this particular iron condor is it's currently trading or closed at 372 ish. And I'd like to initiate this trade with 32 7 372.5. I'd be selling that and buying a $10 wide spread. So either you can go $10 or a $5, depends on your comfortability. I'm just going to try out a $10 wide spread. And since the implied volatility has expanded so much, we should be getting a good deal on this. So let's see. So we will be able to make this particular trade. Let me just post it over here so you guys know what I'm talking about. So we are selling an iron condor on Lulu on 11th December 20th, that is the expiration date. And the sold side of the option would be 372 and a half on the call side. And we buy back 382 and a half. And on the put side, we would be selling 367 and a half, and we're buying 357 and a half. So what happens here is that it's a $10 wide spread. So between calls and puts, the value between these two is $10. So you have $10 is the total value of the spread, and you are actually selling the iron condor, so you receive a 8.77 as a credit. So what is the net investment or risk here? The net risk is 10 minus 8.77 gives you 1.23. Get 1.23 as your risk. So when I say 1.23, you are going to be risking $123 um, risk to make um, 877, which is unrealistic. Your realistic gain on this would be you would be risking 123 to make um, $250. That is your realistic. This is realistic, and this one is theoretical. Theoretical. I hope I spelled it right. Yeah. So let's just analyze this scenario. So This is a neutral spread strategy, which means that most of the gain happens if the stock moves just like that within this boundary that I have drawn. As long as it doesn't go beyond this boundary, you are bound to make this profit, the $250. Okay, what are the other scenarios that it can happen? Okay, well, the stock can go this way after the earnings are announced, which is actually going to happen sometimes around the morning here. Um, so the stock can go up this way. Okay, so what do you do? So this side of your spread will be completely profitable. If the stock goes up, your put side of the spread will be completely profitable, which would be a $10 profit. You would have to close it, and this will be on your completely on the loss. So which means your net risk will be 123. So that 123 will be a loss. And typically when this happens, when things happen like this, there are cases where it could keep climbing up like that, but about 65 percentage chance there's going to be a retracement, so within the same day. And I would wait for that retracement, and I would close this for any break even point, and that way the gains that you have realized on this side becomes your gain. In that case, your realistic profit will be cut down by half. So it's still a good proposition, in my opinion, to risk $123 to play a scenario out with a $250 realistic profit. And if things don't work out, you will lose $123, but on one contract. If you do a 10 contract, you're going to lose 100 and I mean sorry $1,230. If you do a 100 contract, which I do not advise on a Lulu, but if you want to do it, by all means you can do it. If you feel extremely confident that it's just going to not have any movement during the earning, you can go ahead and put a 100 contract, which will be 12,380. But on the flip side, you would be making twice as much. You risk if things work out in your favor. If it doesn't work out in your favor, with a little bit of management skill, you can break even, or you can make 120 dollars profit, which is extremely doable. All you have to do is just follow this, and between you have to put the trade in. Let me just draw a box. You have to put a trade in sometimes around before the 11:30 time frame, and from there, and you would be monitoring the trade up until the 24 hours. That's it. That's all you might have to do. And worst case scenario, this could get pushed up all the way to 2:30. And the simple way to keep monitoring this is just to set an alert here. Like, if it moves, let's just say if it breaks out and moves here, and we closed one side that was profitable, the other side is a complete loss. I mean, when it moves here, you have lost $123 net. But this particular side of the iron condor, which is the 367 and a half and 357 and a half put, will be profitable. You should close this. You have to wait for this to retrace. So when it opens here on the day of earnings, what you have to do here is just to wait with an alert. Just set an alert at the break even point and just say that, hey, if it crosses anywhere down below, give me an alert. And as soon as it gets alerted, you can get it off that position. Or if you're a little more experienced, you can use something like back calculation, or like can project how much it's going to be really worth, um, to make that money back, or to try and flip a position that was negative. Similar trade, I just want to bring it to your attention. A very, very similar trade is what I have done previously and posted all the associated steps with it. Let me just do this. Is one of them which did not work out. I'm sorry. This is one of them that did not work out, but we were able to still manage it. And this is one of them that worked out extremely well. So let's look at the one that actually worked out very well, right? I mean, we had $130, and right after earnings. You don't have to look at all of that detail. All you need is that particular 3 day window. So I put in the trade and it went up. I made some adjustments to the trade and it opened back down here. So all the discussions that you see are right here. So how I managed the trade and how you are able to make that money. And in my case, I have adjusted, so I added more risk and reduced my profitability. And this, um, either way, at the end of the day, I was able to close it for a $200 profit, the entire position. However, if you look at the same Lulu, it was another earning trade, and I did structure it exactly the same, but it did not work out. Why? Because the earning was on this particular day, and I structured it here, hoping that it was going to open. It had a gap open down, such such, and after that, it never recovered back. So, what did I have to lose here? I mean, in this case, I've sold it for ultimately an $80 risk. Would I be would I be happy to let it go for a loss? I did. So $80 risk. Who cares? I mean, you can make a $80 risk back. I mean, you can recover from an $80 loss any day than having a $400 loss. I mean, when building an iron condor, especially around earnings, keep it tight, guys. I mean, there is no reason why you have to go there and buy a $20 wide iron condor and get half as much credit for a $20 widespread. So you get it for what, $15 and $20 wide. You'd be risking $500. Why do that? Just for the off chance that it's going to actually open within that additional $10 window? No. Keep your risk very low. That way you can manage your account and you can keep building it rather than losing your account. That is the main takeaway I want to give you guys. And wish you all the luck, all the very best luck for this particular trade if you are willing to take it up with me. And I have ran through the scenarios here. If you want, I can draw um, a scenario of this one, how it's going to play out. Oops. It could go break out and it could come recover back. And that's what we are looking for. If it's a long, if it's a short, we go this way and we wait for a small little recovery that happens within that same day and you close it out. And all you have to do is just set alerts and manage it. Let me just delete this. So I hope it was easy. So all you're doing here is just on a summary level. Lulu is coming out with earnings on the 10th after market close. Um, so in order to capture the trade, and today is the 8th, we have 2 more days to put the trade. I like to put these kind of trades a day ahead of its earning, which means if it is coming 10th after market close, I put it on 9th. If it is coming 10th pre-market, I would have already been in the trade. Um, so this particular trade that you see here is what I'm trying to do, and which is selling one iron condor of Lulu, um, expiration 11th December 20th, and that would be 372 and a half and 382 and a half. I'd be selling the 372 and a half and buying the 382 and a half call side. I'd be selling the 367 and a half and I'd be buying the 357 and a half on the put side for a net credit of 8.77 per contract. Since it's a 100 contract, it's $877 credit, and the total value of the spread, which is 372 and a half, 382 and a half minus 372 and a half, which is $10, is the value of the spread. You have received an 877 as a credit, and your net risk is 1.23. So you're for a 100 contract, for 100 options, For one contract, it's $123 risk, and your maximum profitability is that you can make 877, which is theoretical, but a realistic profitability is about 250 here, and that's all you can expect at the best case scenario. And if the trade goes against you, you would be closing the profitable side. If it goes breaks out higher, you'll be closing the profitable side, which means the put side of this trade should be closed for maximum profit, which would be a $10 debit. And when it retraces back, set up a break even alert point, and when it retraces back, you let the other side go. As simple as that. This does not take a lot of time. This takes probably 10 minutes of your time in a day to set this trade up, 10 minutes on the day after earnings to exit, and possibly 5 minutes to exit the possibly about 30 minutes for you if you have to do all the other stuff if it goes against you. And that is a cumulative 30 minute. It's not that you're going to be glued to the screen. I don't like gluing to the screen for stock market. It is worst habit. And I believe that you cannot be sustainable if you're glued to the screen unless you're trading futures, where you have a heavy risk. And well, I wish you all good luck and have a good evening. Good luck, guys. Bye.